Have you ever placed an option trade only to watch it lose money even though the stock barely moved? Or maybe your trade suddenly became profitable without much price movement at all. The reason could be Vega, not Vegas. Vega is one of the most misunderstood option Greeks, yet it's one of the most important if you trade options. It measures how sensitive an option price is to change in implied volatility. In this video, you're going to learn basically what Vega is, why it matters, and how it affects different strategies and how professional traders use it to manage risk. Hey, it's Frank Nagy. Welcome to my channel where we help investors understand various market environments, risk management, and alternative investment strategies. If you're new here, subscribe to my channel and hit that like button. So what is Vega? Vega measures how much an options premium changes when implied volatility, or IV, changes by 1 percentage point. For example, if an option has a Vega of 0.30, then if implied volatility increases from 20% to 21%, the option gains approximately 30 cents or $30 per contract. If implied volatility falls from 20% to 19, the option loses by 30 cents. Notice something important? Nothing happened to the stock price. The option changed value simply because the market's expectation of the future movement changed. Have you ever heard of implied volatility? Think of implied volatility as the market's estimate of future uncertainty. High implied volatility means traders expect large future price swings. Lower implied volatility suggests expectations for calmer markets. When volatility expectations rise, options price generally rises. When volatility expectations fall, option prices generally fall. Vega tells you exactly how sensitive your option is to those changes. This is one of many strategies Data Bridge Capital Management applies when managing non-directional investment portfolios with a focus on risk management and market analysis. The firm's objective is to develop structured investment approaches grounded in portfolio construction, risk control, and long-term capital growth. Many beginner traders focus only on one price or price direction. They ask, will the stock go up or down? Professional option traders ask another question: what will implied volatility do? Because volatility can sometimes matter more than price. Imagine buying a call option before earnings. The stock moves exactly as expected after the announcement, but implied volatility collapses. Your option may actually lose value despite being correct on the direction. This phenomenon is commonly called the volatility crush. Not every option has the same Vega. Several factors influence it. Time until expiration. Longer dated options generally have a higher Vega, and there's simply more time for volatility expectations to affect the pricing. Short-term options usually have much smaller Vega. Options whose strike price is close to the current strike price typically have the highest Vega. Deep in the money calls or out of the money options usually have much lower Vega. During those periods of uncertainty, Vega becomes even more important because implied volatility can move dramatically in a short period of time. So what is the difference between positive Vega and negative or short Vega? Well, positive Vega for long positions typically gain value when IV increases. Consequently, negative Vega or short Vega, short positions generally profit when implied volatility declines. Understanding whether you're positive or negative Vega is essential before entering any trade. Institutional traders rarely look at Vega by itself. They analyze it together with other Greeks. Delta measures directional exposure, beta measures the time decay, gamma measures how quickly delta changes, but Vega measures volatility exposure. Professional managers constantly balance these risks. For example, many market-neutral traders like Data Bridge Capital Management purposely build positions that have controlled delta while carefully managing their Vega exposure. The goal isn't simply protecting the market direction, it's controlling risk from multiple angles. Vega measures an option sensitivity to changes in implied volatility. Higher implied volatility generally increases option prices, particularly in put options. Lower implied volatility generally decreases option prices. Long options usually have positive Vega, and short strategies usually have negative Vega. Understanding Vega helps explain why options sometimes gain or lose value even when the underlying stock or index barely moves. Mastering Vega is one of the biggest steps towards becoming a more confident options trader. To learn more about Data Bridge Capital Management and our investment strategies, risk management approach, and portfolio construction process, click on the links below in the description box.